So let's talk about the men behind the team behind this extraordinary growth story of Reliance AMC, Reliance Growth Fund. What about the secret sauce behind this consistency and outperformance, and how they've managed to beat the index for many years in a row. To discuss that, I have with me Sundeep, Sikka, Executive Director and CEO of Reliance Nippon Life Asset Management, and giving him company is his CIO, Sunil Singhania, CIO Equity Investments with Reliance Nippon Life Asset Management. Gentlemen, good morning. Thank you for joining us. Sundeep, Sikka, let me start with you for a change. It's always the fund managers who get all the credit for outperformance, but CEOs also have a role to play here.
Nikunj, I think it's a very satisfying journey for us. I think the kind of wealth that we have created for our investors, and like you said, 1 lakh invested 20 years back is today 1 crore rupees. I think it gives us a lot of satisfaction. I mean, the wealth that Reliance Mutual Fund has been creating for investors over the last so many years. So thanks for having us on the show.
Sunil, congratulations. It takes a lot from 1 lakh rupees invested in the Reliance Growth Fund to take it to 1 crores in less than 22 years. That's a big feat. How does it feel? And more importantly, where do you see this growth fund actually headed in the next 10 years to come? Because I guess the best journey for India has just about begun 2 years back.
I think thank you for your kind words. And I think the congratulations should be to the investors who have had faith in the Indian economy over the last so many years, and investors who have stayed for the last 22 years have seen the returns which the Indian economy and the Indian equity markets can present to them. Obviously, we have been a mode to make that kind of returns. As far as the future is concerned, Aisha, very clearly, the last 67 years we have seen the Indian economy post-independence grow to $2 trillion. Our view is that this $2 to $4 trillion can be achieved in the next 7-8 years. So what we have achieved in the last 67-68 years, the similar kind of economy growth can be achieved in the next 7-8 years. So I think we are just at the tipping point. It's the start. And though the trailing valuations might look a little bit expensive compared to what they were over the last 10-year average, I think if you look at the good times ahead, investors still have a long way to go as far as generating returns from the Indian economy and the Indian markets are concerned.
Sunil, at a time when the world is debating active versus passive, fund managers globally are finding it difficult to beat their index. Your CAGR return stands at an impressive 23.7%, and some would argue that to expect similar returns in a similar duration would be next to impossible because Indian markets are very efficient.
See, the active versus passive debate will keep on continuing. Obviously, in matured markets, which is the US and Europe and some of the developed Asian countries, it is a very important question or a pertinent question to ask because, the stocks are matured, the sectors are matured, and almost 75% of the funds are not able to beat the benchmark. However, in India and other emerging countries which are still growing, things are very different. If you look at even some of the other emerging countries, if you look at India, almost all the good fund houses have been able to consistently beat the benchmark. So I think as long as India continues to grow faster, there are going to be alpha generating opportunities. And though passive funds would become important as we move ahead, I think there is still room for significant alpha to be created as we move forward. So I think our view is that at least in the next 10 to 15 years, there is scope for good alpha to be generated, and as I said, while passive will continue to find favor with the category of investors, there is a class of investors who are looking at good active funds, and I think that is where we are positioned. New sectors, new themes, new listings are happening, and that gives a lot of opportunity for alpha creation.
Okay, we'll talk about some of the sectors and preferred bets you have, Sunil, but to the CEO it's an open-ended question, it's not a debate. Should one apply for your ETF schemes or should one go for your actively managed schemes? Sundeep, Sikka, you're the CEO. What would you advise for a first timer from these levels? And please don't answer me, depends on your risk profile.
No, I'm not going to answer you that. So I'm going to say, I think as an asset management company, we are going to be offering all products, both active and passive. And I think clearly, I mean, as you see, I mean, as Sunil also mentioned, as the markets mature, I mean, there see the active will continue to be very important in India over the many years, especially in the mid cap area. However, when you were to see in the large cap stocks, I think we will see, because the high expense of the schemes, clearly ETFs will start playing a very big role. ETFs will challenge the large cap funds, and that's primarily going to be because of the high expense. But today if you see active funds charge about 200 to 300 basis point, and it may be difficult to beat. I mean, if you were to see the 300 basis point over the next 5 years period, I mean, that's going to take away the entire alpha. So I think as an asset management company, we keep offering both. There are different type of investors. We recently, during the year, we launched 2 ETFs, CPSE ETFs, where we saw more than 5 lakh new investors coming into the industry. So I think we will keep, we believe today the Indian capital market is so under-penetrated. I mean, today, if just 3 to 4% of the population is investing in mutual funds and ETF, I think there is a scope for both. There is a scope for mutual funds, there is a scope for ETF. Different investors will have different preference, but as an asset management company, today, I think as you are aware, we had acquired Goldman Sachs last year, and I think we will continue to focus both on active and passive. I believe both of them will coexist at least for next decade or so in India.
Sundeep, I'm just looking at the staggering returns the small cap fund has made. 42% or actually a little more than that in the last 1 year. The big debate is between large caps, multi caps, or for that matter small caps, and investors are sort of a little confused about, do you still bet big on small caps considering the staggering outperformance they've already seen in the last 2 years? So do you stick by, or do you think in the next 1 to 2 years it'll be the turn of the large caps to outperform?
Again, this is going to be when you're creating a portfolio for an investor. I think the investor will require a mix of both, the large cap and the mid cap. And very clearly, this is where what Nikunj mentioned, but I'm going to say it's depending on the risk profile. If an investor is looking at over a longer period of time, let's take growth fund which has given a return of a CAGR return of 25% is a mid cap fund. Now, these kind of returns, I think a mid cap will always, the kind of risk appetite required for a mid cap fund is going to be very different from a large cap fund. So like I mentioned earlier, as an asset management company, we'll keep offering the mid cap, the large cap, the active and the passive. However, it's very important for every investor to decide, depending on the risk appetite that he's got, how much and in which asset category he needs to go for. But again, I think again, mid cap will have its own volatility, unlike the large cap. But again, as long as the investor is investing for a longer period of time, many times the volatility is a friend. It works to your advantage. So I think I would strongly advise the financial advisors will be in the best position to advise the investors how much to invest in mid cap and large cap. But I think every portfolio should have a mix of both. The percentage can vary.
Deep has nicely dodged my question. I think I categorically asked in the next 1 to 2 years. But Sunil, the same question to you. Do you sense that the outperformance would remain with the side markets? It is the mid and the small caps which will outperform the larger peers.
See, very clearly there is a little bit of you can say over exuberance and to some extent even froth in some of the stocks on the mid and small caps. So our advice would be that investors should be a little bit careful, specifically when they are buying stocks directly based on tips. Having said that, yes, there is definitely a potential for smaller companies to do well. 1 or 2 years might be a shorter period. But as I mentioned earlier, in a growing and emerging economy, some new sectors come into play, and those sectors stocks would necessarily come in the small and mid cap size till the sector or the industry reaches a scale where it becomes a little bit matured. So I think if you are a large cap investors, maybe you will end up buying good companies, but at an advanced or a mature stage in their sort of life cycle. However, in small and mid caps, you are able to buy them younger. At the same time, the chances of some of these companies not surviving are much higher in the small cap space, and therefore the volatility to that extent increases. So our call would be that if you take a 3 to 5 year perspective, there is still a difference of return which one can expect from the mid and small cap space compared to large cap. However, the outperformance which we have seen over the last 1, 2, 3 years in terms of 10-15% difference between the returns of a mid and small cap vis-a-vis large cap might shrink a little bit. So I think the investors have to be cognizant of that fact. So our view would be that if large cap were to give you a 12 to 15% return, which is what we are expecting over the next 3 years on a CAGR basis, the mid and small cap might give you 5-7% more than that.
Sunil, so I'll take the liberty of getting into some market specific questions. And a sector which in a sense is quite puzzling right now is pharma. And the reason why I'm asking you a question on pharma is because I know in the past you've owned it and you've made serious returns by buying pharma stocks at the right price. What's going on with the pharma space? I mean, the price is telling me that nobody wants to believe in the Indian generic story. I mean, why are markets rubbishing some of these good companies suddenly?
So if you actually see, Nikunj, between 2009 to 2015, it was a golden period for Indian pharma companies, both from a profit and growth perspective as well as from the equity market perspective. Somewhere towards the end of 15, obviously there was again, over enthusiasm, and the P ratios of some of these companies had touched 40, 50. I think 2016 was a correction phase, and we saw a good amount of correction. I think that correction is continuing in 2017. It's a combination of a lot of regulatory headwinds, specifically from the US regulatory authority. It is also a function of growth slowing down because of these regulatory headwinds, and therefore the PE multiples, which used to be 30, 40, coming down like 15, 20 PE multiples. And recently I've also had a little bit of headwinds from the Indian side, where the government wants to promote more non-branded generic medicines at the cost of the branded medicines. So I think there have been multiple headwinds. We also have had the US dollar depreciate against the Indian rupee, and that will also cause a little bit of challenge as far as maintaining the margins are concerned. Having said that, we have also reduced our exposure to pharma, but in some of the companies, valuations are now 15, 17 times FY19, which are lower than even the market multiples. The same is the case with even IT companies. And these are good cash generating businesses. So I think at some point of time, you have to start looking at them. Obviously, it's not a sector where you just go tomorrow and buy everything, but you keep a track of it. And when you get the confidence that the regulatory headwinds are finally receding, maybe that might be the time when you start to build positions there.
What the market seems to be betting on right now, Sunil, seems to be this entire affordable housing theme, considering the government's push towards now that, and now the NPA policy as well, seeing the light of the day. Do you sense that because of the under ownership in PSU banks, HFCs of course have already run up, but again the material returns are yet to be seen right now. Do you think that is a pocket which will continue to do well in the market?
So I think as a fund house also, we have increased our exposure to PSU banks over the last 2 months, which is something which is a change from our stance over the last 3-4 years. And our call has been very simple. One is our view is that the worst as far as the NPA recognition is behind us. You'll have 1 or 2 sporadic cases here and there, but by and large most of the NPAs have been recognized in terms of at least being put in the watch list or restructured or recognized as NPAs. Also, some sectors which were really struggling, like steel, have started to bounce back. We are also seeing a significant recovery in real estate, and it is very surprising, but March and April have been good for real estate companies, even on residential sale side. So that was again one sector where there were a lot of stress. And then you also have this impetus from the government on the infrastructure side. There also, with InvIT being accepted and the REITs and other instruments also being around the corner, and the rush for chasing yields, because interest rates have been 6.5–7% as far as fixed income is concerned, would mean that the balance sheet of a lot of these stress sectors should also start to show recovery. And on the flip side, the government also is looking at addressing the NPA issues once and for all. So I think there's a combination of fundamental improvement. There's also a push from the government and the RBI to solve this issue once and for all. And there is also a possibility that with operating profit even inching up 10–15%, the NPA recognition might fall sharply, and that would lead to significant increase in profitability. Also, some of these PSU banks have investments like in housing finance companies, in insurance companies, in mutual funds, in some of the other listed exchanges, and so on and so forth. And I think that value has been ignored by the market. So maybe, as and when those underlying investments get listed, that value will also start to get recognized. So I think all in all, it makes sense to have a small exposure to some of the beaten down public sector names. And I think that call has gone right for us.
Well, I'm coming right back to you for some more themes. I distinctly remember last time you talked about urban consumption, you talked about agri, branded apparel, some themes have done rather well. But Sundeep, Sikka, I have a very basic question for you, and this is a conversation which which we normally engage in with some of our viewers, with some of our friends, and the question is that, look, I'm not getting a very satisfactory return in fixed deposits, but I don't have appetite or the stomach to digest the volatility in equity markets. What should I do?
I think it's a very valid question, Nikunj. I think we are also, when we do a lot of road shows across the country, this is a question which has been coming. There was a time till about few years back, bank deposits used to give a double-digit return. Now, I think today with the returns coming down to, about 5-6%, it's becoming difficult. The inflation adjusted, actually it's a negative carry for people. And most of these people, as you know, Indians have been a little averse to capital markets. They have not been investing in with only 2 or 3% of the household saving coming to capital markets. People have been averse. So I think the first step for anybody who's coming into capital markets, I think would be, who's moving from FD, is going to be an FD plus product, which is a balanced fund, a hybrid fund which has about 60-65% of equity and about 35 to 40% of debt. So there's low volatility. There is the debt takes care of some kind of an assured return, and equity gives you some kind of an upside. So I think the way we have seen, I think we've been advising a lot of investors. One is an MIP, and the other one is a hybrid fund. These are the two funds which we want people to take the first step into mutual funds, because these funds give you something FD plus or FD plus plus kind of a return.
So Sundeep, in terms of a new product category, in terms of a launch, you came out with CPSE ETF. You've come out with an app which is called Simply Save, more like an online digital experience where you can put your surplus in liquid, in liquid schemes. At a time when financial inclusion has started, the SIP culture has started, is there any big product innovation we should expect from you next quarter or so?
Yeah, Nikunj, I think what we've been trying to do is, I think for us, the digital is the new theme. I think I'm very happy to share with you today 1 out of 4 for new purchases that we are getting are coming through the digital mediums, whether directly from the investors or through the distributors, whether it's a B2B to C. And I think I clearly see, I think what as a fund house we plan to do is, I think we want to use technology to reach out to the hinterlands, to the small investors, because I think what we have seen is till now one of the biggest the biggest obstacle for the growth of the mutual fund industry has been the distribution reach. I think we want to give a platform to the digital platform, both to the investors and the distributors. To break this barrier of, because today if you see all the mutual fund, the entire AMC put together, everyone put together is in not more than 200 cities and towns. We have about 180 branches. I think, but if you're seeing the wealth of India is growing in smaller cities and towns, as you are aware, the number of folios from B15, which are the smaller cities, has already has exceeded the folios from the top 15 cities. The flows, incremental flows, the incremental SIPs have been increasing. So I think from our point of view, two things that we clearly see. Technology will be the big thing. I think the Simply Save application that we launched for the liquid fund, I think that is again made to get new investors into the mutual fund industry. Another innovation which we came out recently, the SEBI had also, has come out with the rules and the framework around it, has been the instant redemption. We were the first fund house to come out with that. CPSE ETF was another one. So you will see some more goal-based funds and goal-based products coming out from the Reliance Mutual Fund, and also using technology to reach out and to enhance the customer experience. So you will see a lot of innovations coming over the next 6 months.
Sunil, I have to get back to one of your recent tweets, and you've talked about how the Chicago VIX is now at a 10-year low and investors are seeing extremely low risk in the markets. Do you fear any sort of complacency? Because it seems like this is a global tide which is taking us up all, be it US equities or for that matter, India in the same breath.
No, I fully agree. I think right now there is a view of a consensus view that nothing can go wrong, and to some extent, these are indications that please be careful. And I did mention to you earlier that especially on the smaller companies there is some kind of over enthusiasm, and we have to be careful. So we do expect that there might be a 3-4% reaction in the large cap, maybe a 7-8% reaction on the mid and small cap side. But having said that, that would be a great opportunity for someone who has missed out to invest big time. And our so you can say, confidence stems from the fact that we have never had better macros. We have never had a government working so systematically on structural reforms. And we have never had a scenario where the exchange, the rupee has been so stable, interest rates have been so low, and finally we are coming out of a slumber in terms of growth, in terms of execution, in terms of government policy. So I think things are looking pretty good, and our view is that with monsoon forecast also being normal, we might be in for surprises as far as both growth as far as GDP is concerned, as well as corporate profit growth. So in near term, yes, there is a possibility of small reaction, but I think we remain very constructive from a 1-2 years perspective.
You've been recently betting big on HFCs and PSUs, of course, like we just talked about, but also agri, urban consumption, some of the cement majors as well as what you've been liking in the recent past. Whenever that dip does come in the market, would you look to allocate more and buy more of these names on dips?
So, our view has been that agri obviously is a big theme. The government is focused on increasing rural income, in ensuring that there is more stability as far as agri income is concerned. We have a good forecast for monsoon, and also there is a clear focus from the government to increase our irrigation facilities, so the vagaries of monsoons are behind us. I think all this would mean that rural income would rise, and therefore all agri-based themes, whether it is rural consumption or agrochemicals or fertilizers, should start to see much more stability and growth as we move forward. In terms of infrastructure, again, we are looking at a trillion rupees of investment. That is what our Minister of Transportation has talked about. We are looking at massive connectivity as far as air is concerned. We are looking at coastal shipping and so on and so forth. Metros in multiple cities. All this would mean that infrastructure also is a good theme. However, our view is that construction companies particularly, there are not too many with decent balance sheets which are listed, and therefore we are playing it through the cement space, because cement benefits indirectly from an infrastructure boom, and it will also benefit from the big push towards housing for all. In terms of urban consumption also, post demonetization, we have seen consumption coming back to normal. We are of the view that as economy revives, there will be growth in the job scenario. And also there is a big possibility of shift from unorganized to organized post GST. So I think even the urban consumption is a good theme to play. As far as allocation is concerned, I think it's an ongoing process every day, based on valuation, based on flows, and based on our view on the market. I think it's a continuous allocation and reallocation which we continue to do.
Okay, let me get closing comments from you, Sunil. Do you think the leadership in the market has changed? Suddenly it's no longer Eicher Motors or Page Industries or TTK Prestige. It's inward looking sectors which are doing well. So if names like Page or a TTK Prestige have dominated Indian markets for last 2 or 3 years, what could dominate markets in next 2 or 3 years?
See, Nikunj, market looks at growth, and market also sometimes gets a little bit confused because there are not too many companies offering growth. So in a scenario where growth is in scarcity, companies which are offered sustainable, decent growth tend to trade at multiples which are much higher than their intrinsic value. And that was what was happening over the last 3, 4, 5 years. I think now that is changing. There are a lot of sectors which are offering growth. There are a lot of sectors which are showing optimism. And therefore the market is becoming much more broad-based. Ultimately, the market is a reflection of the future profitability and the expectation of future profitability from all companies. And I think earlier there was a handful of companies which was offering that. Now there is a wide spectrum of companies which are offering that. So I think what we have seen over the last 1 year in particular, and our view is that going forward even for the next 2-3 years, is going to be a much more broad-based markets, where the valuations are going to be a little bit more you can say spread out, and the range is going to narrow much more. So yes, as I mentioned earlier, companies which look exciting, include some financials, niche financials, including our views that exchanges, gold finance companies, housing finance companies, select public sector banks, corporate banks, urban discretionary spending themes, infrastructure themes. All these look like growing much faster than the overall market, and I think that is where the valuations are coming back on track. So it's going to be a much more spread out market.
Okay, Sundeep, Sunil, congrats to you both and your entire team at Reliance Mutual Fund once again for achieving this great feat, and I hope there's a mega bash planned celebrating the victory.
Thank you.
Thanks a lot. Okay.
Because you wanted to say something?
No, I have just one complaint. I'm sure unit holders don't have any complaint, but Sundeep, Sunil, with such solid outperformance, why do you guys hide so much? I mean, our media team has to keep on reaching you. It's a tough trek to get you on television. With such outperformance, you both should be coming out more often.
You don't like our faces, Nikunj.
Well, we can book on next appointment right away. but
because I think we just want to use, we'll just request you to use this Reliance Growth Fund, this 1 lakh becoming 1 crore as a case study. I mean, so that I think more and more investors start looking at capital markets using the mutual fund route. Because if you look at this entire journey, in 20 years, so many things have gone right, so many things have gone wrong. But I think this is a classic case of investors who had the patience and trusted an asset management company which could sail through different market cycles. I think rather than we coming on TV, we want you to educate the investors. The best way to come into capital markets is the mutual fund. I mean, through asset management companies which can sail through different market cycles.
There's no guarantee of future return. That is what your document also says.
I can add one more thing here, Nikunj. Earlier we used to all look at foreigners, that what are they thinking, whether they're going to buy or sell. Now when I go abroad, all the foreign investors are very curious to know what the domestics are going to do, whether they're going to buy or sell. And I think that is a transformation which has happened thanks to the great Indian retail investor. We don't need foreign investments now to ensure that the markets remain stable. We don't need foreign capital. Obviously, that is more than welcome, but we have enough domestic capital. If it is channelized properly into financial assets, the country can grow really, really remarkably.
Sundeep, how about saying one good line for media, that media also has played a good role in investor education?
He said, and he wants to take the baby forward. He said that.
No, I want more brand investors in media for mutual fund industries, and I think I'll especially compliment ET now. I think you've been doing a lot of good work to get new investors into the capital markets. I think today's this program also, this 1 lakh becoming 1 crore rupees is another one. I think you're just trying to educate the investors. I mean, if you have the patience. So Nikunj and Isha, thanks a lot, and keep doing this good job of getting new investors into capital market.
Thanks, guys. We're officially now part of Mutual Admiration Club. We'll let you go on that.
Find us on Facebook at facebook.com/etnow, and don't forget to click the like button. You can also follow us on Twitter at etnowlive. To stay updated with all our programming, hit the subscribe button on our YouTube channel by logging on to youtube.com/etnow.